Welcome to Empowering Innovation, Trends and Triumphs, a podcast series dedicated to the success and challenges in innovation and growth within the UK tech startup scene.
Hello and welcome to Empowered's new podcast, Empowering Innovation, Trends and Triumphs. We are very excited today to have Nikita Baranov here with us from Fuel Ventures, who'll be talking to us about the changes in the VC environment and how the volatility that we're seeing at a macro level across the UK and broader is actually affecting and bringing in some new challenges for early stage businesses. My name's Hari Sandhu. I'm one of the founders at Empowered, and having been through the process, myself of setting up a business, going out, engaging with the VC community, the whole wider ecosystem. This has been I've been able to see actually that there's been a huge change in the way that the ecosystem works and how we approach, VCs themselves and how VCs look at, great opportunities. So we thought actually, given that it's the start of a brand new year, what better way to kick it off than looking at some of the headline opportunities and challenges that are facing early stage founders. So with that said, we'll get into it. Very broad brush, thinking about how is the funding landscape different for UK tech SMEs compared to other regions or industries?
Sure. So it's thank you so much for inviting. This is I think it's a great timing to kick off 2024 actually with a few insights about anything to do with funding, startups, ideas, everything what to sort of expect and exactly that, how does the whole landscape look right now? So I think always great to sort of compare Europe to US. US is a leading market in terms of, and let's say, the pioneer of VC investments and the whole ecosystem. So the way that UK looks right now is that, again, traditionally most of the capital sort of sits around later stage investments. Hence the reason why a lot of startup founders, when they get an opportunity to raise in States, they sort of try to go to States because the statistics is sort of favors the late stage investments in the UK. So 70% of dry powder sits within Series A sort of and plus, and the remaining of it sits within the early stage sort of pre-seed, seed, follow-on investments. Now, similar kind of concept, or let's say the similar sort of numbers of distribution is in Europe. However, that starts to change because you've seen more ex-entrepreneurs starting their own funds. They're more risk takers. They're more operational sort of entrepreneurs that start their own VCs. So you start to see more capital going towards early stage, which is good. So I think going into 2024 with things sort of getting a bit better on the micro side and more on the economic side, I think that's going to be beneficial for whether that's early stage investors or companies that are looking to raise funds, for their pre-seed or seed rounds.
Excellent. So do you see the UK sort of leading in that regard, or do you see the UK looking to Europe for inspiration?
Well, UK actually, I think it's third in the world for the number of invested capital and also for the number of unicorns that is produced. So I think the way that it goes, well, I think it's 2020, 2021 statistics, it was the United States was the leading one in terms of number of unicorns, then it was China, and then it was the UK. So the UK is undoubtedly probably the next sort of go-to after the US ecosystem. And we've seen a lot of great companies, specifically in sort of fintech marketplace sectors, right? I mean, you have the TransferWise, the Revoluts, right? Deliveroo. So you see these sort of companies emerge that start in the UK and continue to grow in the UK. And I think the UK is kind of the emerging leader or the tech hub for Europe for sure. But we are slowly getting to the point where you start to see, that UK sort of starting to compete with the US in terms of capital that's being allocated into startups, and also the number of great companies that emerge and then compete with the US.
And there's been, I guess, if we leave, I guess, China aside, if you think about the ecosystem in the US and particularly the West Coast of the US, and the ecosystem built up around startups in the UK, and I guess predominantly that would be around certain zones, southeast, north, northwest, that sort of area. There is still a lot of I guess the UK has developed quite a bit in terms of trying to emulate what's happening over in the US, but there's still some secret sauce that's missing, especially early, at the early stages. Is that something that you guys see as well? That I guess the kinds of opportunities that are becoming more prevalent in the UK versus some of the opportunities that maybe get picked up over in the US?
I think UK has a very good infrastructure for sort of establishing great companies and great opportunities. So where do great companies come from? I mean, you sort of look at the universities graduates, right? Sort of coming up with ideas there and sort of trying to scale. It's active professionals who discovered a gap in the market and then sort of left the industry and this corporate sort of industry and decided to pursue it. So in the UK, it is up there. I would say that the primary focus in terms of most of the opportunities that come out of the UK professional corporate world or the universities is sort of within fintech and within marketplaces. And this is exactly where the early stage VCs are looking for. So at Fuel, we particularly like, at least in this current environment, we're sort of more liking the business models like B2B SaaS, marketplaces and fintech platforms. And that is sort of similar across other VC funds in the UK as well. And it just happens that UK is a financial hub of Europe.
Yep,
so you get to find a lot of great
a lot
deals.
of innovation takes place in that industry.
Exactly. Yes.
Yeah. So, given the current economic climate and this this phrase, the Great Tech Reset, that we've been hearing about. So, from your perspective, what are some of the biggest challenges founders and finance leaders within early stage businesses in UK tech face when it comes to securing funding?
I think it's the investor confidence. I think this is where, let's look at more from both sides. So if we look at from the side of startups, there are two issues that they're currently facing. One is that if you're a startup founder, you ideally want to have a better valuation, the highest valuation that you can get, right? So which is not the case currently. I mean, we've seen 2021 being that last year of hyper overvalued companies, and things have sort of got a bit on a discounted side since then. And I think what founders are sort of struggling currently is to make a good case for, especially early stage, right? Pre-seed, when you just have a workable product and limited traction, it's hard to convince an investor that the company is worth twice of what the VC sort of offers them, right? I think that's one problem, is is making sure that sort of finding the right argument to justify high valuation, which is sort of hard. The next problem is that investor confidence is sort of trying to stay back a bit, right? Not to over invest and into different companies, and they're more on the reserve side. So the number of opportunities out there currently is obviously not as large as it was, like, let's say 2021, and that goes for institutional funding and sort of private individual angel funding as well. But the upside as well is that during the problematic times, founders manage to identify problems better, and investors also manage to find the next big companies that solve big ideas. Because look, we look at 2008, that was a big economic sort of constraint, and you think of it as like, who's going to be investing in this time, or what kind of startups could come up, because the confidence to do anything is kind of low.
Mm-hmm.
But then, because the market is so divided, that you can actually spot where the weaknesses are, because when everything is good, things start to, like, I guess founders start to get a bit more comfortable with how, let's say, everything sort of works,
how to play the game.
and and then when infrastructure starts to break, you see these gaps, and these gaps are problems that founders come in to solve. So in 2008, you saw, companies such as Airbnb, such as Stripe, let's say the last mile delivery companies. Again, these are the sort of ideas that emerged from crisis when things were really bad.
Yep.
So currently is the same kind of thing. So I guess the idea, or the assumption, is that founders who launch startups now, they're going to be more aware of what the problems are. And for investors, it's good, because if you look deep enough, you could find great opportunities. But the second benefit is that you can find these opportunities that enter these companies at a lower sort of valuation, which is, again, sort of gives more upside to investors, right?
So I mean, the higher upside, like the lower valuations, surely isn't that also driven by the fact that, I guess, what investors are looking for now has changed as well. So the definition of a great investment is different now than it was maybe 12 odd months ago.
It changes, and I think like economic cycle determines what sort of area you want to look at. And I think currently, let's say, to put it very bluntly, consumer sector, sort of B2C companies and ideas are, let's say, they're more on a less preferential side, purely because consumer market, the households spend less.
Well, there's less right now. There's less disposable income, right?
Exactly.
Yeah.
So it's and the thing is, B2C products, it comes, unless it's something that has to do with like necessities, like pharmaceuticals or food or something, right? So these things will continue, because they have more, I guess they're more inelastic, and they're essential. So for everything else, consumers would probably kind of pull out of additional spending and stuff like that. However, that's not the case for B2B businesses, because if I am a B2B SaaS platform that automates a large part of your business, sure, things are not as good and fancy as they were when money was cheap and economy was growing, etc. So, but you as a company owner who subscribes to some B2B platform that, let's say, optimizes your accounting processes, stop paying for that service will make your life even harder. So your life as a business is already sort of challenging, but there is a reason why you opted in for certain platforms, is because it makes things efficiency, right? So it's these kind of products, I'd say they're more strategic in a way, because we know that even if things really go bad in the economy, there's certain products out there that these like few ventures has invested in, that we're confident that their clients are not going to turn their back at them and sort of say like, we're not going to use you anymore. So B2B SaaS is actually, again, one of these business models that that is relatively stress-proof when the economy doesn't really work that well. But then even when the recovery begins, you have you have more opportunities to expand these, even B2B businesses. But usually you are more on a sort of you're more on the cautious side on the consumer market currently. But again, if things start to pick up, consumer sector could be a more, let's say, scalable, fast growth sort of avenue for both investors and founders.
One takeaway, I guess, for me here is that if you're an essential consumer item, there's still a deal that could be worth pursuing for you here, and VCs would be keen to talk to you. And B2B businesses, it's still business as usual, but there's still opportunities within the VC land, right, to be able to get access to funding to enhance your growth potential. But if we circle back to the point of valuations, the valuations are still lower, even if you have these types of businesses that are operating well. There is still a dampener on those valuations, and at least from what we are hearing, a lot of that is based on a need for sustainability within businesses.
It's almost like a prerequisite right now because the cost of capital is more expensive, and we're not in the same sort of time and age where you could thoughtlessly deploy capital and sort of rely on the next investor to bid at a higher valuation and sort of like piggyback of that. Now I think in at least for our fund, we really look at how capital efficient the company is and how capital efficient the founding team is, because this is probably an important ingredient right now to ensure that if we do deploy capital into a startup, that they will be able to survive and not raise 6 months from now, right?
Not have to raise,
right? What we think is really crucial right now, and I think this is more of being, because again, investors are in this time of ages are also trying to be more capital aware, right? We want to understand that if we invest into company that we believe can grow, but we understand that the scale that this company really needs to reach would probably require an additional funding. So we still want to participate in specific deal or in specific solution, but we want to also ensure that they're not going to come back 6 months and ask for more. So where the focus goes today in comparison to, let's say, 2 years ago, is how will you distribute that capital? How will you allocate it? Are you being, as a founder, are you being more strategic in terms of acquiring a customer? Are you dumping all your money into Google Ads and that's what you rely on? Or you sort of being more intellectual about it and more creative in terms of how do you source your traction and how, and again, it will all at the end be reflected in numbers, in the margins, right?
So I mean, it leads me on to another really interesting sort of area, which is that for early stage organizations who are trying to find a product market fit, who are trying to find an audience sometimes, right? For their wares. You can't really get away from that as an early stage business.
It's absolutely right that it sometimes takes a trial and error to find the right product market fit. And this is why it's really crucial that the founding team actually knows what they're doing. At least they have the domain expertise, because that to an investor, it gives, I guess, more confidence. I guess this is why you would probably hear a lot like, okay, if you're going into a fintech business, you sort of expect founding team to be from that domain. Like you cannot, or at least, of course, it's not wrong to go from medicine to fintech, but it will take you longer time to figure out what the product market fit is and to understand deeply the roots of how the whole system works and where the gaps are and whose problem you're solving and where does customer located. And I think these are the sort of stuff that I guess what is essential and which reduces also the risk of how early stage trial and error is going to happen. So you as an early stage founder who just created an MVP and let's say you identified a solution, but you sort of feel like you want that market confirmation, being a domain expert, you are more likely to understand at least the whereabouts of where your target customer is. So yes, true, it will require you probably a few attempts to figure out the right niche to then scale your product to, but at least you're not gonna go completely into the woods blindly, and you will have a clear roadmap. And this is why it's really important to, from a perspective of VC, it's really, it's better to see founders coming up with ideas that in the domain that they have previously worked in. So whether that's from professional experience that, they worked 10 years in payments at some big corporation, they come in and say, I want to make payments, cross-border payments more efficient, and then it's like, okay, well, you understand how you're going to do it, and you understand who will use it and whose problem.
So is it fair to say that in the environment that we're in, the time we're in now, domain expertise trumps, early enthusiasm, trumps enthusiasm. By that I mean, we're, through, the mid 2010s, there were lots of organizations being set up where, by enthusiastic but relatively inexperienced, individuals who kind of left university, maybe had a year or two's worth of experience, and then decided to set up an organization. Like for those, would the guidance to that individual looking to set up their own business be, well, actually, you'll be better off spending a couple of years in industry, gaining some experience, and then rolling out to pursue this idea?
It depends, right? I mean, there are so many companies that were founded straight out of university, and social media platforms, right? Payment, well, some of the payment platforms maybe, but you sort of see you see a balance, right, of things. Like you see a bit of university graduates starting and making work, but these are usually, first of all, it's very rare cases that straight out of bachelor's you build a big scalable business. Usually you kind of surround then yourself with great advisors who have domain expertise and guide you. I guess that's. You could say that success of Google, success of Facebook, that was pretty much due to great guidance from external advisors that made it that turned it actually into a business.
So it'd be helpful to understand what would be for a pre-seed investment that that you'd be excited about. What would that need to look like?
So it's I guess so depending on what kind of stage we're looking at. So let's say if we were divide the early stage investment between pre-seed and seed, then what we're looking for, in a pre-seed ideal company is, it's the founders that ideally are from the domain, that understand it, that can that can defend their product thesis. I think that's important. From, let's say, the product operational side, like it's essential to have a workable MVP that has already been used by a small number of customers, but have yet not been perfected to a level where you can just scale it to thousands of other new customers, unlike you would do and be expected in your seed investment. I would imagine that it's being aware of what your real market is, because I think one of the problems that I see that when you look at your sort of like the founder's total addressable market size, it's sometimes quite naive, and it really puts the whole excitement off, because you sort of feel like, okay, is it an experience of a founder? Do they really know their market? And so you would find a solution to a problem, and then you say, this market is worth 2 trillion, and you're like, no, it's not. It's not worth 2 trillion, right? So you start breaking it down, and you're like, actually, your market is, 300 million in the UK, and then out of that 300 million, you could probably service like 10% of it or something, right?
Yeah.
So for us, it's essential that the market is a billion plus, and this is your not just a total sort of market. This is what you can attain as a business, right? So because this is where the unicorns are built from, right? You want to have, you want to service that 1 billion plus dollar sort of customer, and that's not just the UK. That's
Global,
Europe, global, right? So we're looking for global ideas, global, let's say, problems that concern not just someone in London, but problems that concern everyone in the UK and Europe. So this is where we can derive scalability from. And if you're looking at pre-seed, is about having a product that really solves a problem that solves a problem of a billion plus sort of market in the UK and sort of globally, right? So that's the pre-seed. Now the seed is where us as a VC going to have a bit more expectations of startups, right? So it's not enough just to have identifying a problem and having a solution. We want to see customers paying for your product, coming back again to buy your product, and we want to see your customer growth sort of expanding, like they talk about the J curve, right? I mean, yes, ideally the wish list is the J curve, and you want to see that kind of trajectory. And the seed round is about already finding the product, identifying your product market fit, knowing where your customer is, how much it's going to cost to get the customer, already having a portfolio of, let's say 6 months of operations where you see, your monthly revenue breaking that 10,000 pound mark per month, right? And seeing it consistently growing at a quite substantial amount to demonstrate that you are building that exponential scalability here, right? So, and again, it's why would someone raise seed? Companies are raising seed is to get on the market fast, to accelerate the growth. Seed is all about execution. It's all about, I guess, sales, right? If it's a B2B enterprise software, right? So what VCs, our ideal kind of profile is, an opportunity. It's a company that has the main founders' expertise, that have a great product, already identified product market fit, and now it's like, okay, this market will continue to grow at, ideally double digits every single year. And this is how we're actually going to get through to that customer. We want this amount of money because now we're just going to print our, whatever we have identified as our product market fit, we're just going to use that capital to just print and repeat and that's how we're going to grow. So
helpful.
Yeah.
That's really helpful, very thorough. But one of the things that both at the pre-seed and at the seed level, would be helpful to kind of understand would be the element of sustainability, capital sustainability and discipline. And that would be different for a company at the pre-seed level versus the seed level. And then hugely different, between a seed level to a Series A, level for a business. And you mentioned that the capital sustainability would factor into any sort of decision making. Would it be fair to say that the capital sustainability or the discipline is less of a determinant at the pre-seed level and more so at the seed level? And if so, how does it differ? What do you look for?
It will definitely be it will be different because pre-seed you're still in that phase of working out what exactly you're doing, right? I mean,
and there's a lot more experimentation.
Yeah. So it's less strict at the pre-seed level comparing to seed. I guess the core difference will be because at pre-seed you're gonna have you're gonna have less hirings. You're probably gonna have less sort of marketing. It's still sort of, it's still your core founding team that's gonna operate the funds, and it's given for a time period that will, runway will be less, right? So there are a lot of kind of differences, and it's again, it's the capital efficiency for pre-seed would be to find as soon as possible the best way for your product to be placed in, right? And
would you expect, if you were investing in a business at pre-seed, would the expectation be that by the time the next funding round is needed, that the company has enough traction at least to be able to break even, or at least to have a path to break even, or even at that level? Or is that not really
breaking even? I think if you have growth as one of your ingredients in the equation, breaking even by Series A will be hard. I mean, you don't see it normally. It's because the reason why you don't, and even early stage VC funds do not expect companies, I mean, definitely not pre-seed, seed as well. Like, we don't expect them to break even and start becoming profitable by the end of the seed round, because growth equals spending, like high spending. So regardless of how capital efficient you are, you won't be a profitable business by the end of your seed kind of runway if you're focusing on growth, right? It is very rare that companies that raise their seed round become profitable and then just kind of stop it there in terms of attracting additional capital and sort of rely either on the operational profit or use other sort of financial tools to grow their business, and while not sacrificing the equity, right? So but it's I think
I guess that's why I was asking the question, because I mean, so much conversation in the VC community over the past 6 months has been about sustainability, and so it creates a picture in one's mind when they hear that look, if I'm going to go out for funding, I need to be able to demonstrate how I will sensibly deploy these funds to generate growth, but not just the growth, but I'll also demonstrate a path to profitability. Maybe not get to a break-even point or become profitable, but I need to demonstrate a path to becoming more like that, right? And if that's true, at Series A and later, to what extent is that still true at seed and pre-seed as well?
Essential. Like, you want to see the roadmap for how the whole company is sort of going to develop. Because again, the important thing, I guess, from a perspective of VC is to not look at what's going to happen with the company in like 6 months' time, right? It's, great that you could find potentially your customer and you will be able to work it out, but it's all about where do you see the company in 5-10 years time, right? And if and it is right at the beginning where you kind of expect to understand how that development will evolve. And it's also it's a green flag for a VC to see founders that are coming into pitch, that they are aware that, hey, we're not going to make money now. We're not going to be profitable next year or maybe the year after. However, this is why we're not going to be profitable, because the profitability is a sacrifice for growth. But then what we're trying to achieve through the sacrifice is that by the time we actually get to, let's say, post sort of seed Series A, is that we're going to start, I guess, reshaping some of the things, or I guess we're going to reach a certain size that will allow us to then have, more, say, favorable financial outcomes, right? So the idea is of course, to build a business that is profitable, because at the end of it, it's a business. But the problem that and again, like, I don't want to speak for everyone, but personally that I see that the reason why everyone focuses on growth, no one focuses on profitability, is because of these great fancy years when capital was so cheap that the business model was not creating a workable business. The business model was to create as high valuation as possible and then find the next bidder to bid at a higher price, and then cash out and leave, right? And forget about what's going to happen with the company. Now, I think this is where things started to change in, I guess, 2023 going into 2024, is that I think people realize that, entrepreneurship is about building a business, is about, making sure that your debit and credit makes sense, right?
The old-fashioned entrepreneurship that, I don't know, parents' generation,
and
familiar with.
But that's a business, right?
Those fundamentals are coming back into play again.
What exactly is needed, because you can't really go far on, it depends, right? If you are a founder who scaled the company to $1 billion, but then you're making, 200 million or whatever in losses, and you keep raising every single year, and you're like on Series Z, XYZ now, you probably cashed out a lot of, and got quite a bit of cash for you to not care about it and just go and retire. But again, I think the culture was pivoted to, because of these high valuations and stupid money, was pivoted towards, the absolutely wrong avenue in terms of how businesses should be built. And I think that has created a very bad picture for the first-time founders, because in their mentality is like, hey, it's about raising money, or it's about like, hey, we need to raise our seed. So what I actually have seen, and that's with some of the startups that I've talked to outside of Fuel, and that I meet and some sort of pitching and stuff, it almost looks like their number one priority is to raise funds. I'm like, and when exactly are you gonna, in your whole, storytelling, when exactly are you gonna tell me about how exactly you're gonna do the business? Like, you focus, like, we're gonna have this valuation, we're gonna raise this now, we're looking to raise this and that, and it's just like, why are you not focusing on the business, right? Why are you not trying to bootstrap? And this is, again, coming back to your question about what sort of founders we'll look at. We want to see sacrifice, like entrepreneurship, especially for pre-seed, right? Because there's not much data to play around with. So it's more about, I guess the instinct of the investor to see whether they see the potential in the person, because it's more about the team, right? And the best, the green flag in the early stage pre-seed sort of startups is to see founders really bootstrapping to the max. And when they come and they say, hey, Mr. Investor, we've reached that ceiling, we want to grow, we cannot, we've bootstrapped everything, whatever, like we've invested our own money and we got to this point, or we haven't invested anything and we just threw our own kind of
sweat equity that we built up in the business.
And that's great. And I was actually speaking to one startup a couple of weeks ago, and I was just, are you looking to raise or anything? Like, no. I'm like, okay, so why not? He's like, we're bootstrapping everything. We're doing it ourselves. We don't want to give away. We know that the valuation you're going to give us is not something that we like. So we're just going to continue working it out ourselves up until, let's say, things, rebalance a little bit, and, investors are going to be a bit more proactive with, and let's say, more favorable with what sort of number they set on company's value.
And where the business needs a step change potentially as well. Yeah. Okay, so that's really helpful, because part of what I took from there was that it's, even if you're not able to draw a path to, profitability, and that's unnecessary. I mean, and impractical potentially at a pre-seed stage. But if you can demonstrate frugality, if you can demonstrate an appreciation for cash, for capital, right? If you have a sensible plan for how for the point at which you need to, a business could start to go from being hugely, offloading huge amounts of cash to one where actually you're starting to conserve a bit of cash and actually, using your own reserves to invest into the business, having a path to that and being able to articulate that to an investor right now, even at a pre-seed stage, would still be a valuable thing to have.
It's I get, like, we talk about the lean startup model, right? Ability to be super fluid, managing to pivot quickly when necessary. I think that's really important as well, because the problem sometimes that could arise between a sort of investor-founder relationship is that, especially first-time founders, that they're so motivated and fixated about their initial idea that when someone external comes in and sort of says, hey, actually we looked at it, maybe there is a better avenue, a more efficient way of building out your business, why don't you consider it? And then it's like, no, I do it my way. I don't care, like I'm gonna do it my way. This is the best way to do it. And I think this is also one of the, this is a red flag as well, because you as a founder, you want to be as fluid as possible and be welcome to feedback. And feedback, it doesn't only come in valuable when you build a product and the customer feedback to alter your product, but it's also about, it's everything. Like, how do you structure your business? Because again, investors, they care about startups. They don't just deploy capital and then, hey, you know what? We know that our business model works the way that one startup needs to become a unicorn to cover all our losses in case that happens. So, we're not going to be super active with you or whatever. No, it's actually the opposite. The investor is supposed to be your best friend during that whole journey, especially at the early stage, pre-seed and seed. This is when investor is not just your capital buddy, but is your partner. It's your, this is why, let's say, Fuel is, I guess, really good at it from that founder and investor relationship, because we become operational with you. We essentially use our expertise of our investors to help founders, find a faster, more efficient way of getting things over the line and growing their product, acquiring the customers, retaining the customers. So it's the ecosystem and the value that we provide. So the founder is not expected to be super fluid and become and say yes to everything. Of course, there should be some challenging dialogue sometimes, but it could also become problematic when the founder said, you know what, I'm going to do it my own ways. And sometimes it works, but most likely it's not going to work, especially with the first-time founders.
So a level of openness and receptiveness to external advice is an important flag.
Of course.
And and that has been the case in the past as well, but that continues to be quite a major thing now as well.
Of course, no, absolutely.
And do you also, on the flip side of that coin, do you also now see founders rocking up to an investor, expecting the investor to add more to their business than just capital, and being able to add some of the operational expertise, as you were saying, being able to provide guidance, not just, here's cash and, we'll see you, at a quarterly board meeting or whatever, but actually we're going to be working with you, especially early on.
Yes, it's probably, it's a good, I guess, selling tactic for startups to raise funds. Is like, hey, you're not just an investor, you are going to be more than an investor. They all say it. Now, a lot of them are genuinely interested in getting the help of investors as well, and getting exposure to experience, to the network that the a lead or co-investor will have. So the answer is yes, especially for VC funds where, let's say, the investment committees are consisting of ex-entrepreneurs, because then they will actually understand the same pains and struggles of early stage founders. So I think this is a pretty common thing across all early stage VCs, that a lot of them emerge and founded by ex-entrepreneurs. In the case of Fuel Ventures, Mark Pearson, who was a successful entrepreneur that exited business and set up, an investment vehicle. So there's a lot of connection in that sense. So I think founders do really express, an honest interest to get that extra help from it. And again, that but then they also need to understand that, they won't be prioritized and sort of like, nobody's going to be babysitting them at the same time either. Because, when you have 160 plus portfolio companies and 20 people in the team, we can't it's also quite hard. So we're there as an investor, we're there as a point of contact to get help with whatever is needed. But at the same time, we also rely on, entrepreneurs' independence to actually manage things, right? So
fine. Yeah. So it sounds like VCs are, it's a broad category, but if we speak, specifically about fuel, and other VCs that invest at the pre-seed or seed sort of stages, there's an appreciation within those VCs that investing into a company isn't just about putting capital in, but it's also about providing support into those organizations. But there needs to be reciprocation on the other side. Yeah. So the founder and the founding team and the wider business need to want to hear what the VC has to say, but then also not look to the VC to be the operational arm for the business, but to kind of take on what they're being told, the guidance they're being provided, and then execute on that.
I think that's pretty well summarized. I think this is something that doesn't change with
whether it's a more trying time right now, like in the wide, a more trying macroeconomic time, or a less trying macroeconomic time from a couple of years ago. That would still hold true. Is that what?
Of course, yeah. And maybe now it will be more, because you sort of expect, in more difficult times you want to be a bit more united in a sense. So I would say that, it works regardless of what stage of economic cycle we're in. But when things are sort of tough, then you kind of want to see a more, a better bonding, more interaction between two parties, right? Between investor and founders. So
is that one of the ways that I guess VCs look to stay closer to their investments as well?
Yes, and with early stage, it's important because, as a fund, as a lead investor, you ideally want to continue invest in companies that you've backed before. So it's not like, let's say we come in pre-seed and then sort of let them go to someone else. No, we want to, and this is again like a really important thing for founders to search in their next VC fund that they want to get backing from, is that does that fund actually, do they support their founders beyond just a pre-seed round, let's say, right? Yeah. Have they followed through with additional funding to that company, and it's really important, because if you get, let's say, if you get a fund to lead your pre-seed and then lead your seed, right, and then give you that follow-on, right, that it's a very partner-heavy relationship. It's great. So I think this is where, just without being biased, Fuel is really good at, is that we back our companies all the way through sort of like pre-seed, seed, and follow-on, obviously subject to performance, but we try to stick to our portfolio companies for as much as we can up to Series A before we kind of let them go into the open sea or to the other parent, right, and things like that. Because from an investor perspective, it makes sense as well, because let's say we invest in someone at pre-seed, and why do we need to go somewhere outside if we have someone that like if we
Well,
have
you've
a
got
company that we know,
known entity, and you've
that
bought into their
finance.
journey as well,
Yeah.
right? Yeah.
We've shaped them in a way that relationship works nicely between investor and a founder. You know, they've listened to, let's say, to feedback of their consumers, of the investor. They change things. You know, we understand them better. So why not continue to support them, right, at the seed round? And then obviously Series A, that's where I guess the investment approach changes, and it becomes more of a sort of numbers game rather than, you know, here's the problem solution. This is the team, traction, product market fit. It becomes more of a, I guess, it requires different expertise. So for us, it's ideal to support the company all the way through, you know, all the way through that sort of journey, and help them afterwards find the good sort of Series A investor as well, because that's what we do as a fund. That, you know, by the time we kind of reach a point where we cannot support them anymore because our focus is more early stage, we help to match them with, let's say, a more late stage fund that we think would be a good fit for them, so they have that smooth transition and it won't affect their operations in some way. So it's pretty unique.
And so if we take what you just said there about, you know, what, you know, obviously wanting to structure a business for continued success, one that you're already, you know, that you're already working with, that's already within your portfolio, and linking that up with the point now with, you know, this significantly increased focus on, you know, financial prudence and, you know, potentially breaking even, you know, profitability and the like. Are earlier stage VCs providing some of that, you know, maturer financial support and financial thinking into their investments as well, into their portfolio companies?
Absolutely. The answer is for sure yes.
And that wasn't being provided previously as much now as it is now.
I think it was less it was prioritized less before. Again, you know, VCs are financial institutions at the end of the day, right?
Exactly.
So for us to add value from capital allocation side is, you know, I guess we have the credibility to do it, right? Of course, companies then get their own CFOs and things like that, but a lot of them don't. Like you see co-founders in pre-seed sort of level startups that are sort of like commercial CTO, right? And CFOs can get quite expensive, and we don't obviously act as some sort of audit firm for them or anything, but just a kind of guidance and advice. So I think this comes in quite helpful. But again, financial sustainability right now is probably the key, and it begins right from the point where we do the due diligence with companies. Is that the conversations that we have with founders it evolves around that. So that you know, asking the question, okay, how would you structure your whole capital allocation post raise? You know, where you intend to spend the money. So you already at the point of sort of just when you met the team and you start looking deeper into the numbers, you already establish, you know, you already kind of make each other understand that, okay, this is going to be very diligent financial process throughout.
So the level of financial maturity, it sounds like an earlier stage fund would be looking for now, is quite a bit higher than historically might have been sought. So by that I mean you an earlier stage fund now would probably be looking at, like, does this company, let's say at the seed stage, have a clear understanding of, have a more robust, accounting mechanism within their business? Are they able to track where the costs are going, and are they able to track metrics within their business in a reliable way? Are they able to draw a clear line between top line growth, bottom line, to the position of the bottom line as well? So that level of financial understanding, as you're saying, is an important part of the conversation right from the get-go.
Yes.
Where maybe even 18 months ago, that may not have factored as much within the conversation?
Correct.
It's more about the growth maybe at that point?
It's still important, for sure. I guess it is an important matter, 100%, because we do try to understand how the margins, let's say, would change with the business as it sort of grows, right? So that that's sort of like your output of your initial financial processes, right? To make sure that you're not burning too much cash, you're making the right margins, or you're on path to sort of decrease them, or to take the company onto a profitability in some point in time, right? So
would you expect an earlier stage business to already have a finance function built into the business at that
hard
at that
to say
point? Because
it's hard to find, like for pre-seed, when you don't have any back data, you cannot understand.
All those folks, they'll be focused on building the next MVP.
Yeah,
trying to get that out, right, and trying to test that out,
and it's hard to we're not expecting them to come up with
have
discounting cash flow model, for the next 5 years.
Yeah,
it's hard, right? Yeah. Even like seed round is the numbers, of course, like the number due diligence, the financial due diligence comes into play a bit more than pre-seed, but it's more like pre-seed is all about the product market fit. It's like, okay, sure, you might have some sort of, as long as they have some sort of sanity in their plan, that's okay. But we don't expect them to tell us all the way to, like, very granularly to tell us, like, this is how much revenue we're gonna make in month 2 in 5 years time, right?
Yeah, that would just be
fiction anyway. So it's more like even the financial models that founders build up for their pre-seed raise are just more like they're very basic. Like this is how much it's gonna cost me to run a Canva account, and then this is how much it's gonna cost me to to pay for my Google ads, and that's like my salary or whatever.
I'm paying 5K here, 3K.
Yeah, it's very simple. Yeah, very very sort of simple thing. But of course, in terms of numbers for pre-seed, it's more like, okay, this is it's just being honest about what your addressable market is and what sort of revenue streams you're gonna derive from that.
Off the back of that. Yeah. So I mean, before we wrap up, I just want to make sure that we cover off like one particular area, which is around how VCs engage with potential opportunities, like potential businesses that are looking, to raise investment. And are you seeing things? Are you seeing anything? Have things changed in the way that either you reach out to companies looking to raise, or companies reach out to you, and where those opportunities come from? Has that changed in the last 6 months or so?
I think for an established VC, the deal flow is not, let's say, a big problem in terms of its quantity, because so Fuel Ventures gets a lot of its deals through like inbound applications, websites, and stuff like that. Of course, recommendations from our investors is also like a great avenue of finding these sort of deals, right? Because if you are an individual investor into a fund, and it happens to be that you also work in finance, you work in the finance world, so you get to hear a lot of that, like emergence of some sort of startups first before someone else sort of hears it. So that kind of deal flow is essential as well. Events, I guess there were a few times when, say, pitching events that are organized by whatever organization, whether that's university or some sort of accelerator sort of group, there could be some opportunities as well. Accelerators, I mean, that's the whole kind of thing that, you know, someone from Antler or EF that comes out and starts to, they're already sort of vetted by a previous investor, but then sourcing deals from accelerators has its own downsides as well.
Challenges, yeah.
But I think, yeah, the deal flow never stops. You're always going to have people looking to raise. And again, like as we started the podcast from the fact that there is not much dry powder and early stage investments in the UK. So you get, you know, I guess VCs are in a more fortunate position because they have a large inflow of potential opportunities to kind of look out for.
You know, what we read about outside of the industry is that the volume of deals has shrunk significantly as well. So the number of investments being made by VCs has shrunk as well.
Yep.
So is that a fair reflection of the reality?
Overall, probably yes. But then if you take it, you know, so if you look individually at different funds, like you might see differences. I can only speak for my fund for fuel. Like for us, things haven't really changed in terms of the number of companies. We continue to commit to the same sort of the companies that we did, say, last year, the year before that, right? So we understand that it's harder to raise capital to deploy, but again, we sort of continue to deliver on the whole promise of that we want 20 companies for our pre-seed investment, you know, 10 to 15 for our seed. Like it's important, right? It's you can still raise funds to deploy, right? But the business model will then break down if you don't continue to stick to your original thesis. Because if you know, if last year it was 10 companies, this year it was 5. If 5 don't work out.
Exactly. You need some of that consistency.
You need consistency for sure. So it's hard to raise funds. You can still raise them. It's harder, but like, look, it's die or survive, right? Like you know, it's live or die. So like we need to continue to to uphold our initial thesis that worked so far, and we know that if we try to pivot because there is some market conditions that don't favor our, let's say, the overall VC market, that doesn't work for us. Like we need to find ways to raise new funding, to deploy. Opportunities are still there. I think Fuel is probably one of the most followed VC funds in the UK. One of the go-to funds for early stage founders as well. We're always welcome to view and to view new opportunities and stuff. And we're super fluid as well in terms of what ideas come up, because we're opportunistics. We want to find, we want to discover things that even founders might not, like, let's say the upside that we could potentially discover in a startup that the founding team might not even see initially as well. Yeah, so
being too close to the trees, right? Yeah,
exactly. I guess the takeaway in summary from my side is that, like, I guess I use hard times to turn it into opportunities.
Yes, exactly. Yeah.
VCs are always open to invest. At the end of the day, the business of a VC is to invest, right? So it's not like they're gonna stop. They might cut back, but they're not gonna stop, right? I think the piece of advice for founders is, well, twofold. Is the one, understand the VC that you're sort of pitching to, because there's a lot of times founders don't actually look carefully at the investment thesis, and then they made a really bad impression of themselves by thinking that, hey, we think that you would be a great investor or partner with us, and then we're like, okay, well, actually we don't invest in biotech. Like you need to understand the VC the same way as you want them to understand you. Like that, doing the research on their thesis is important. Looking at the companies they invest in. Like, again, if the fund has invested a large amount of money into someone that you believe is your direct competitor, pitching to us and hoping that we're gonna sort of, let's say, think of it as another great opportunity is more or less likely because we're already committed to one company that competes with you. So I think this is really important. Understanding investment thesis, understanding their existing and past portfolios, knowing the team again, you know, when you say, okay, why do you want us to be your investors? Or because you're going to add more value than just money. Okay, well, why is that? Well, that's because we know that your managing partner did something in that space that we know we operate in as well, so we would be able to find that synergy. And the second thing is that just bootstrap as much as possible, build up traction. That is going to help founders as well to negotiate better terms with VCs, because if you have a great product, just go to a customer and, you know, see whether they're going to buy it or not. You know, test that out first before going to investors, because then you're going to, you know, first of all, you know, investor will probably send you back to get traction anyway, so you're just going to waste time looking for investors. So it's like focus on the business, on financial sort of sustainability. Make, you know, think of it as a business first rather than a fundraising gig.
Vehicle,
yeah. So I guess that's it. And there's no need to go to America to raise funds. I think UK is a great country to do it, and it's going to continue to develop further. So yeah, that's pretty much it.
No, look, Nikita, it's been an absolute blast. Thank you very much for your time. It's very much from my perspective, it very much still sounds like, you know, if the fundamentals of the opportunity are sound, you know, investors are still, you know, keen to hear from you.
Of course.
So do reach out. Don't think the drawbridge has been pulled up. It's very much still business as usual.
Of course.
You just got to make sure you do your homework ahead of time.
Exactly. And for anyone that will watch or hear this podcast, please, you know, feel free to apply, to pitch to Fuel. We're always open.
Wonderful. So again, thank you very much. That was hugely insightful. If you'd like to get involved in this podcast series, please do reach out to us via marketing@empowered.com. And if you haven't already, do hit subscribe. We look forward to having you join us for our next episode. Thank you very much.
This podcast has been brought to you by Empowered, a platform and service for R&D tax credit claims.